Inflation is still coming in hot, and the Fed hawks get vocal. Apple takes a hit on an antitrust ruling, and with quad witching expiry this Friday, people are expecting some volatility. All this and more in this week's Macro Insight. Welcome to Macro Insight, everyone. Today is the 14th of September, and let's take a look at these markets. All right, so last week, high CPI prints both out of China, approximately 10% on core, and the US was above 8% on core, right? So clear evidence there that supply bottlenecks are persisting around the globe. And that kind of triggered some Fed more hawkish members to say things like, price increases are going to persist for longer and backing tapering and things like that. The Fed's Mester, I believe it was, but she's not a voting member yet. But you are seeing, as well as those sort of large PPI prints that are being driven, more from these port closures and high commodity prices. CPI is also a concern, and obviously we had a CPI print just come out to just literally now, which the market seems to have taken well. So that's I guess not a particularly high CPI print, but you've got inflation expectations, consumer inflation expectations, which are theoretically a driver of actual inflation, right? If inflation expectations become unanchored, then that often means that inflation then will be higher. And you had this, see, New York Fed 1-year inflation expectations at a complete, all-time record there of over 5%, right? So just some people are getting nervous that the Fed is losing control of inflation expectations, and that's going to make it hard for them to control inflation. Now, obviously, there are other factors, and we're going to go through those. So US and UK are US and UK are both talking about higher taxes. So we're potentially going to get higher taxes, a reduction of global monetary policy stimulus from some kind of taper, even though it might be a soft taper, it's still some kind of tightening. You've got China trade frictions rising. You've got obviously a slower service sector recovery from the fact that we've seen, COVID herd immunity taking a bit longer to get than we might have first liked, and the need for potential booster shots in a lot of places that have got high take-up rates. And that's causing bank strategists to, see downside risks in equities, right? So economists are downgrading their forecasts. I mentioned that last week, Morgan Stanley, Goldman, etc. But now a lot of the bank strategists are even looking for 5 to 10% pullbacks in the market for a number of reasons. So persistent inflation pressures, despite a weak labor market, have got a lot of Fed members saying that they still favor tapering, right? So whereas we were thinking on that poor non-farms the week before, does that sort of dampen the case for tapering? Well, from what the Fed members are saying, arguably they're more concerned about what the inflation data is saying. So, bit of a mixed message we're getting out of the Fed, okay? And then you've got, like I say, fiscal policy. If we do get the higher taxes, which we're hearing about, then that is going to be a bit of a drag on consumer income and therefore demand side as well. Okay, so quite a few macro headwinds starting to form over the skies to look out for. Outside of macro, you had Apple, a court ruling on Apple saying that they can't force developers to use in-app purchasing. So that was in favor of Epic Games. There was a court case going on there, and that's basically putting a big dent in a lot of money that Apple makes out of that, right? They've got some 75% margins or something on that, which are pretty high. And that stock was down late last week by about 3%. Okay, so we already had a bit of nervousness from the kind of headwinds that we were seeing, and a lot of banks sort of signaling that a correction was due. You then had this Apple price action that was pretty bearish. And then what's happening is, well, we're heading into the expiration, which for the last 3 months in a row has led to a bit of a correction sell-off in the markets. So people were also a bit nervous of that. So all those factors culminating and seeing a bit of corrective price action in the S&P. Okay. Let's have a look at the S&P chart in a bit more detail. So here, so if we look at the S&P chart, you can see that once we sort of broke below that volatility trigger level, okay, which is what the spot gamma guys were calling around 4,500 last week. You can see, whereas we were fairly range bound, once we broke that level, these arrows are just indicating that the Bollinger Bands and the volatility in the market expanding, basically, right? So you can see that they said if we break 4,500, the market's a bit more choppy, and that is kind of what we're seeing, right? So the size of the movement has gone up since we broke below 4,500. And then after that as well, the markets, the option in open interest and stuff has shifted down a bit, so that they're calling the new call wall that 4,500. So that should now act as a bit of a resistance level for the rest of the week, according to their metrics. And that worked pretty much like a charm yesterday, as we had a decent bounce, but we basically ran out of steam just shy of that 4,500 level to then go and retest those lows. Okay, so for now, you've got to favor that 4,500 is probably not a bad entry point from the short side. I actually did use that as a short entry, just a tactical sort of futures trade, and that worked pretty well, right? But when you've got those sort of levels, you can run relatively tight stops where you can sell into that level with a stop maybe, 45.10 or something, and that kind of sets up quite nicely, yeah? And then, yeah, so like I said, the new sort of call wall is 4,500. And they're thinking, the kind of gamma flip zone where we kind of are flat to getting short gamma is now below that 44.80, 44.70 area. And then they've got another level down there at 40, they're calling it the vol trigger again, right? 44.25. So I guess what they're saying is now the market's kind of digested this initial sell-off down to here. To trigger a bunch of more turbulence, we're going to need to break 44.25 to the downside, right? So, given the price action that we're seeing, I think that's fairly unlikely this week, but keep an eye out below for that level of 44.25 to maybe trigger some more weakness, yeah? So that's kind of where the S&P picture lies. NASDAQ also, had obviously had some weakness, Apple being a big weight in that. And we had kind of flagged the week before that we had momentum divergences forming, right? So you can see the momentum picture was deteriorating whilst we were kind of flatlining above the top of the market there. And now we've had our pullback, right? Surprise, surprise, the first bounce level was around the Fibonacci retracement of that last leg higher. That's held for now. If we do get another bout of weakness, a pretty big level is around this 15,200, 15,250 area. I suspect that's going to hold, and I'd be looking for that to hold if we were to go down again, basically, right? So, but that's kind of what the NASDAQ looks like. VIX wise, as we have had a correction in spot, the VIX did trade higher. It traded up as far as 21 last week. It has got smacked a bit. The expiry is on Wednesday. That could be driving the VIX a little bit in terms of expiry flows. But generally, what you're seeing is VIX spikes are happening very quickly on not a whole lot of movement, right? So if you look at realized volatility, we're still seeing 10-day at like 7, right? So 10-day realizes at 7.5. VIX is still at 18.5, 19. I mean, that's a massive implied vol spread. Now, a lot of that spread is coming from the richness of skew, right? Because the VIX number doesn't just take into account at the money vol. It also cares about the levels of skew and convexity in the surface that are providing that spread, okay? But it's still telling you that the market is is pricing in a fair amount of risk premium to the downside still. Okay, so it's telling you that actually the markets aren't as complacent as we might think they are at all-time highs, because that volatility surface is showing you that there's demand for protection there, right? It's something that obviously that Darius Dale talks about a lot, and it is kind of true that you're less likely to see major crashes in the market when you know there's been a lot of put buying demand and the skew is very expensive, basically. Yeah. Okay, so that's kind of what we're seeing in vol. I personally think selling into spikes, if you were to get more of a bid in VIX going into FOMC next week, like back above that 20 area, maybe 21, 22, that's probably not a bad opportunity to sell into, given that what we often see post FOMC is just a vol reset, basically. Yeah, so I think that setup might be there if we can get another little down leg in markets between now and next Wednesday, which is when we've got FOMC. Yeah. In terms of sector breakdowns, we're seeing leadership from, some of the recent leaders are pulling back. So we're seeing retail, healthcare, and real estate pulling back. And we were seeing energy stocks actually outperforming on the back of, crude prices going higher, basically. Right. So that was, that was basically the main kind of what was going on in sectors. And even though a broader correction in markets is due from what a lot of these bank strategists are saying, and we haven't seen a 5% plus correction in God knows how long now, my personal feelings here are that we are likely, the Fed's bark is probably bigger than its bite. And in FOMC next week, we may even get a dovish surprise. Given that, because what happens is a lot of these Fed speakers talk hawkish, and then when Powell comes out, we actually find that no, they're actually a bit more dovish than we thought, right? So that wouldn't surprise me if we see that pattern play out again, and we don't get a firm timeline on tapering, because that gives them optionality, right? What the Fed loves is optionality. Everyone loves a free option, right? And by not giving a firm timeline, they can give themselves optionality to say, and to maybe push tapering into next year if the data warrants it, right? And that's what I suspect we might see next week, if I had to put my cards on the table, basically. Right. And then also, I think there's a bit too much consensus in the view that we're going to get a correction, right? So we've got various surveys that are done by various banks, and you've got here, this survey, I can't remember which bank did it, but basically 60% of people are expecting a 5 to 10% correction by year end, right? So it's not a scenario that's going to catch anyone off guard, the market pulling back, it seems, right? Like we said, the buyers in this market are much more formulaic, price insensitive. Yeah, they're just buying. They're either corporate buybacks or they are passive flows coming from pensions. They don't care if they buy it and the market corrects 5 or 10%, right? But the discretionary market that actually is trying to generate alpha and time the moves and stuff, they're all sitting there waiting for a correction, and they probably don't own enough of the market as they should. And actually the thing that's going to catch people off guard and hurt people is probably more of a rally, right? A move to 4,800 to 5,000 area by Thanksgiving is probably the scenario that no one's really ready for, right, or prepared for, yeah, in terms of the discretionary community. So, for those who want to play that type of move, for that non-consensus view, maybe, you could take advantage of the fear in the market, and you can basically sell November puts, and you say the November 4,200 puts, right? So if you look at where the S&P is right now, that's where we are. 4,200 is, pretty far away if you look at where it is, right? I mean, obviously on that uptrend, it looks like we're bouncing already, but if we got back to 42, that would be a pretty decent correction where we're likely to see support. And you can basically sell the 4,200 puts in November, and you can buy 12 4,800 calls for the same premium, right? That's the order of magnitude, right? So if you think the market's at 4,500, 300 points downside put you can sell, 300 point upside call you can buy, and the ratio you're getting is 12 to 1, right? that intuitively gives you a feel for how expensive the skew actually is, and that people aren't really thinking that's the likely outcome in options markets, basically, right? So something to look at. If you did choose to do that type of trade, bear in mind that that is a short skew trade. You're taking unlimited risk on the downside when you sell that put. So only sell that put in a size where you are comfortable buying the market in that size at 4,200, right? If you size it appropriately in that way, then it's a safe trade, and you can use that premium to get leverage to an upside move to 48, which is possible, basically, right? If we remain in the Goldilocks setup, then, you know, where the Fed is kind of there, and we think liquidity is there and the bond buying is still going on and the liquidity is finding its way into asset prices, that might not be a bad setup going into the next month or two, basically. Yeah. All right. So that's kind of what I think on equities. In terms of what's coming up this week, data-wise, like I said, we just had the CPI, kind of need to look through the numbers and drill into it a bit more, but the market seems to have taken it quite well. We've got China retail sales and industrial production tomorrow, Eurozone industrial production, US empire manufacturing on Wednesday, retail sales out of the US on Thursday and the Philly Fed survey, and then Michigan confidence on Friday, right? So a fair amount of data, but nothing in isolation that's going to be that market moving. It's just more taking all those data points and seeing where they're all kind of generally pointing to. I saw this calendar, which is quite useful if you want to know what's kind of coming up. So if we look a bit further out than just this week, here, you've got, you know, the main things to look out for over the next sort of 6 weeks or so. Obviously, you've got the FOMC next week. You've got German federal elections coming up as well. They've got deadline to pass this infrastructure bill where they're going for, you know, whatever, 3.5 trillion, I believe it is. UK furlough schemes ending, not great for us, those who are here. But then you've got the eviction moratorium ending, could impact the housing market there. Set payrolls that everyone's going to be looking for, those numbers to improve. And then you've got the debt ceiling deadline sometime in mid-October, right? In past episodes of the debt ceiling, you know, generally this stuff tends to get done, but it can go to the 11th hour because of political posturing. Don't be surprised if you see a load of noise around the debt ceiling debate. But I'll be surprised if the market's going to react much to it because they'll be expecting some sort of 11th hour solution on it. Yeah. There was 2011, I believe, was the time where the market did actually have a bit of a debacle on the debt ceiling because they really strung out the debate for too long, and then the US got downgraded and markets had a bit of a sharp correction. I don't anticipate that happening again, but you know, you have got some market commentators saying that, you know, this debt ceiling debate is going to be kind of the most sort of scary one that we've had in a while, right? So look out for it, but don't expect the market to react too much unless we really get a bit of a nightmare scenario and they don't pass it and it's looking like a debacle. Yeah, but for now, I'm kind of discounting it, to be honest. Yeah. And then, yeah, a few of the other things, Japan general election, ECB meeting, and then FOMC later in November. So those are your kind of big sort of dates to be aware of. And if you're kind of looking at, you know, buying optionality, then it might be wise to kind of include some of those dates for those events that you think are relevant, basically. Yeah. Okay. So that's where I am regarding what's coming up. In terms of FX markets, the dollar's been very boring and very range bound. So if we bring up the dollar, not really a lot to say, right? It had its pullback. I've called it directionless, right? We had its pullback, it hit the top of the range, pulled back to 92, and now it's just sitting there kind of in the middle of the range. Nothing too exciting going on in the dollar. Yields, on the other hand, yeah, I mean, yields have been similar. They did try and push up against the top end of the range, maybe threatening 140 on the 10-year, but that got rejected, and yields have been pretty range bound as well. So CPI obviously has come in and yields have done nothing. That was a potential risk for yields to move. I had said I thought rates vol was, coming down. The move index was coming down. Kind of expect that's likely going to continue as you have these counteracting factors between higher inflation on one hand, but then weaker jobs data on the other hand. So rates don't really know where to go. Another interesting sort of dynamic within the rates market is even if you get higher inflation numbers and you get tapering, which should take yields, let's say, higher, and you've got more issuance coming from the Treasury, as we said, you've got indirect bidders showing up in the auctions last week that showed that foreign demand is actually pretty robust, right? So when you look at FX hedged treasuries for foreign investors like Japan and Europe, you see that they're picking up an extra 100 basis points relative to their domestic bond markets, basically, right? So if you've got 10-year yields, US Treasury 10-year yields, FX hedged, minus bond yields, and the same thing for JGBs, then, the 100 basis point pickup, I mean, back in December, that was 50 basis points, right? So that's a pretty healthy pickup for bond investors. So that is supportive of treasuries. And that's why treasuries are going to struggle to break out in a meaningful way with higher yields, basically, whilst you've got those sort of differentials for global bond investors. Yeah. On commodities, you've got oil having a good move up. So it had this sort of downtrend channel, got taken out. We had big drawdowns in terms of inventories. The data on COVID looks like it's peaking. If you look at the US data, you look at global data in terms of cases and hospitalizations and things like that. And then storms in the Gulf of Mexico causing supply disruption. So a lot of factors there, fairly, bullish, likely to support oil prices. Yeah. If you look at commodities in general as a space, whilst they had a bit of a pullback on the China credit impulse turning over earlier in the year, you're seeing, people saying that maybe the China thing has bottomed out now, right? Some of the policy measures coming in from China, even though they're going after certain sectors in their economy, and that's not great for the equity market. In terms of credit, the credit impulse may have bottomed, whilst if you look at the other countries, the developed countries, that credit impulse is rolling over. So people are wondering, is the commodity market now at a bit of a local top if the rest of the world credit impulse is rolling over? I would argue not clear. If China's bottoming, then China demand might pick back up in terms of commodities, and that might counteract what's going on in G3, right? So I don't think it's a given that the commodities rallies over. And if you look at some of the price action in things like nat gas, and obviously, we'll look at uranium in a minute, but some of these commodities are just going through the roof, right? And there's just no sign of them stopping, right? So massive supply squeeze is happening in a bunch of commodities, right? And that brings me to uranium, which is like probably the most exciting one at the moment. We flagged it last week as a trade that is going well, and that was on the back of the Sprott physical uranium ETF. But they upsized their buying, basically, right? So they basically added an extra $1 billion of room to how much they're going to buy. And that is just squeezed the market like something crazy. And then on top of that, you've got Wall Street bets getting involved, right? So as Wall Street bets tried to get involved with silver and it got smacked back down earlier in the year, they're now having a go at uranium, right? So, Cameco, which is like the biggest uranium miner, is the favorite name on like Wall Street bets sentiment. Okay. So you had, literally within a matter of weeks, you've had that stock up 55%. You've had the uranium ETF up 85% from its local bottom, but like 3 weeks ago. So uranium's going a bit crazy. I mean, from my perspective, I've been building positions in Cameco and some other miners because I believed in the longer term fundamental story that uranium would be needed. There was a supply deficit, the clean energy agenda, all of that stuff would require more and more uranium to be used, right? And nuclear power was going to be a big feature in the future. So that was the kind of argument that a lot of, smart commentators have been talking about. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.